Hi everyone, okay, what to hedge, second video, and let's start from the end of it. You might probably seen the item on profit and loss statement called foreign exchange fluctuation or effect or effects difference or whatever. It goes like that. You have your profit and loss statement, you have your revenue, you have costs, you have OPEX, you might have many more other items with different names and meanings. And somewhere here you have other. And within other, normally you have FX if you're international multinational company. And in some cases that FX difference might be big. Remember last example, it was 1 billion here. It was, I don't remember, it was 100 cost of goods sold and it was 840 million US dollars equivalent here, and with other it was 0. In what cases that 0 might come different from 0? In case you have some balances. For example, if you have at your balance sheet accounts payable in currency, assume it's euro, and you have 1 billion euros payable, that might cause you a huge FX difference. How these FX difference appears? What's the reason for that FX difference? Assume you've purchased something from someone and your payable is that big. It was at the beginning of the year, let's say 1st January 26. And what when? And you have to pay it 31st December 26. At this point, you know the rate. The rate is 1.2, but the rate is unknown here. And at any other date, the rate is unknown. No one knows. So let's say this is for the year 2026. This is purely forecasted, almost certain. Let's just imagine that it's possible, but this guy is uncertain. And if the rate goes somewhere, and it will go somewhere, obviously. For example, in the middle of the year, the rate goes to 1.25. That means that now your liability in United States dollars, not 1.2 billion anymore, but 1 million. Sorry, it's not here. It's June. It's not. And in June it's 1.25. And it becomes 50 million more than it used to be at inception. What it means to your reporting, these 50 million, it was 0 here, 5 here, multiplied by 1 million accounts payable, it goes to FX of 50 here. Okay? quite a lot. Remember, we have remaining 60, and 50 is almost everything from what we have in our profit and loss statement. That's another what to hedge. How to avoid it? Several scenarios. You can naturally offset it by accounts receivable position, if you are able, obviously. If you might sell in the same currency and at least approximately have some kind of asset in the same currency that will go, its valuation will go in opposite direction. If it's payable, it's with minus your balance sheet, and you will have receivable with different sign. This fluctuation in FX by 0.05 will cause you 50 as a loss from accounts payable and 50 as a gain from accounts receivable. So it will naturally offset it. That's the best option. That's the best scenario. Another option is to jump into the forward contract to have your rate fixed. Let's say it's 1.22. These 2 points will be your forward points that you paid for their predictability, and it will cost you expenses for $10 million. But this is the payment for predictability. You are buying forward contract for €1 billion, and to fix the rate, you have to pay something, and the payment is hidden here in these 2 points, and this is forward contract. You might also use option, as we discussed before, but the principle is the same. What? You have to identify what you are hedging against. And if you cannot identify what you are hedging against, please do not hedge, because that will cost you money and efforts. More than that, efforts. There are a lot of efforts hidden in that exercise. You will have multiple discussions with a lot of parties, with a lot of banks, a lot of paperwork that might not be necessary for you in your current situation. So you have to estimate this. Okay, summarizing, know what to hedge. And this FX difference comes from the balance sheet items revaluation. Okay, then you have something on balance sheet, accounts payable or accounts receivable, in currency other than your functional currencies. Believe me, it will hit your FX here. The best way to deal with it is to naturally offset it somehow or to decrease this number. Let's make sure it approaches 0 or almost 0, but better to have something with offsetting value. Okay, let's continue in next video. I will pause for now.